Greetings, my name is Kevin Matthews and I am the tax professor. I want to welcome you back to class. Class was never out of session because the learning never stops. And so what I want to talk about today is we're going to talk about a topic that comes up oftentimes when we've delivered the tax return to our clients. I get questions about these tax rates that we give people, and normally when we hand people their tax returns after they've been processed, they get 3 tax rates here in the firm, my firm, Beta Solutions. The first tax rate that they get is the marginal tax rate. The second rate that they get is an effective tax rate, and the third one that they get is a capital gains tax rate. Now, generally speaking, what happens is after we've delivered these, we'll usually talk about tax planning and tax planning strategies, and all 3 of these are important in order to be able to do a lot of that tax planning. And so we need to keep those, they're all important, is what I'm trying to say. It's not like you can say, well, I like marginal rates, I like effective rates, or I use this, blah, blah, blah. So what we want to do is we want to make sure that you have a clear understanding as to what these different types of rates are and how they're used. Prior to getting into that, we have to talk a little bit about the American tax system, okay? So the tax system in the United States is what we would call a progressive tax system. Now that's talking about income taxes. Some people will talk about how they want a flat tax, for example. We actually have a flat tax in the United States. It's our Medicare tax. And you will know how much money you pay in Medicare tax when you take a look at your W-2. And if you look at boxes 5 and 6, 5 will tell you how much you had in Medicare wages, tax, and the tax reported that you actually paid is going to be shown in box 6. Now, in 2018, and for many years going back, the employer has to pay the same amount. So if you take a look at that and you double the number, that's how much money has been paid either by you or on your behalf for Medicare tax. And so it's very important to know that we do have a flat tax in the United States. It just doesn't get talked about a whole lot, okay? In the United States, we have a progressive tax system when it comes to our income tax system. Now, what does that mean? It means that our taxes, as you earn more money, your tax rate goes up. Now, it doesn't go up in a smooth curve, so to speak, but what it does is that there's these different brackets that have been set up, and if your income, taxable income, falls in between a range between 2 numbers, that's going to be your marginal tax rate. Now, some people get a little confused about this, and we'll talk a little bit more about it when we get there, but about how those tax rates work. So we're going to get into the topic that we're actually talking about today, and that's that marginal tax rate. Now, marginal tax rate is the tax on that next dollar that you're going to earn. Okay, so if you say, for example, you have a salary of $250,000 a year, and so your marginal tax rate was 28%. I'm just making that up because the brackets aren't right in front of me, unfortunately. What would end up happening is that if you went from $250,000 to $250,001, that $1 is going to be taxed at 28%. Okay, so that's why and we call this the decision rate. And the reason why is because if you're going to be making any tax decisions, that marginal rate is going to be what you're generally going to use for the planning in order to be able to figure out whether it's a good tax decision or not. Very good example, if I own a small business and my small business is reported on my personal return, and say I'm at the marginal rate of 37%. So I'm going to go file my taxes, and I'm going to go buy something for, say, $10,000 that's going to be for my business. I can receive a tax deduction off of that purchase because I can expense 100% of capital assets in 2018 going forward. I'm actually going to get $3,700 worth of benefit on that because of $10,000 times 37% is $3,700. So in effect, that piece of equipment that I've just bought didn't cost me $10,000. It actually cost me, and this is only for federal, obviously there's state rates apply, but for federal, that piece of equipment actually only cost me $6,300. And so that's an important thing to take into consideration. So if you're looking at, I'm going to go out and I'm going to buy all this stuff, wait a minute, what's the after-tax effect as a result of this? And so that's why we tend to want to give our clients the marginal rates, okay, because they're what we call the decision rates. And so that's an important rate that you have. Also, if you go to cocktail parties and people are talking about what their tax rates are, 99 times out of 100, they're quoting their marginal rate. I would bet dollar for donuts the majority of Americans have no clue what their effective tax rate is. And the reason why is because the way that I hear them talk. You know, where they basically say, oh, well, I paid 37% of my income to the government. And I'm looking at their tax return, I'm like, no, your actual effective tax rate, which is the amount that was actually paid based off of income, was actually much lower than that. And we'll go over that when we talk about it. The last thing I want to talk about with marginal rates is a big popular misconception that I see when talking about this. I've had people who come to me and basically say, Kevin, I've decided that I don't want to work as much and I'm going to reduce my income. And the reason why I want to reduce my income is because I don't want to get taxed as much anymore. I'm going to reduce my income so that I can go to a lower rate. And that's not really how this works, okay? It's not like, you know, if you know, and here's the thing, like I was saying before, that we have a progressive tax system, okay? So it's not like every single dollar is taxed at the same amount as you're making your money. So a very good example, if you take $400,000 and we break it out, and we'll just say that's $400,000 taxable income. We're not going to worry about deductions or itemizing or whatever, but we'll say $400,000 is your taxable income that you're going to get taxed at. You're going to get taxed at 0% or 10% at, you know, from 0 to whatever the bracket is up to. And then there's going to be a 12% bracket. And then there's going to be, you know, the various brackets that you're going to go through. And so if you see, you know, how that works out, your lower amounts of money are going to be taxed at that lower amount anyways, which is the main reason why, you know, reducing your income in order to save on paying taxes actually doesn't make a whole lot of sense. And here's why. First of all, because it's taxed at different rates as you go down the bracket, and you reducing your income ain't gonna change that, okay? You will change the amount that your next dollar is taxed at, but you'll actually be hurting yourself in the long run. So say, for example, I have an opportunity to make an additional $100,000. I make $400,000, so I'm at the max tax rates. And so basically I'm going to make a decision as to whether I'm going to take this or not. And there's some people out there who basically would say, well, I'm going to give up the $100,000 so that I don't have to pay this higher tax rate. First of all, like I just said, it doesn't affect any of your income that you've already earned, okay? This is where we start getting into how much income are you really going to take home if you take this additional dollar that you're going to be having, or in my case, an additional $100,000. So I have to take that tax rate that I have, which I'm going to be at the marginal rate, the highest marginal rate, which is 37%. And I'm going to multiply that by the amount of income that I'm going to receive, which is $100,000. And that's $37,000. So I'm going to stroke a check to the federal government for $37,000. Now, I'm ignoring state taxes just for purposes right now. So we want to ignore that for now. But essentially, I'll stroke a check for $37,000, so my actual take-home pay is going to be $63,000 on that $100,000. Okay, so you're going to give up $67,000 or $6,300. I'm sorry, $63,000 because you don't want to stroke a check to the government for $37,000. I'll make a deal with you. Why don't you go earn the money? You can pay me the $100,000, and we'll call it even. Okay, that's something that we definitely want to encourage our clients to take into consideration. Is, hey, look, go ahead and take these additional jobs because you're going to earn extra money. Yeah, you have to pay a higher rate, but you know, sometimes there may be some ways that we can do some tax planning around it. But you know, again, that's for another video and not for this one. So the second tax rate that we normally talk about is the effective tax rate. And the effective tax rate is the easiest in order to figure out. Is take taxable income, or take tax divided by taxable income, that's your tax rate. All right. Now, different software programs will calculate it differently. Some of them will take it based off of AGI, which is your adjusted gross income, and then some people will actually take it off of your taxable income. My program takes it off of taxable income, and that's because that's, you know, that's where it kind of gets boiled down to. And it should be off taxable income in my opinion, but you know, I know that there are some systems out there that take it off of AGI instead. So the third tax rate that we generally deal with is your capital gains tax rate. Now, why am I talking about capital gains tax rate at the number 3? I'm sneaky, I set it up this way. And so the reason why we talk about it here is because your capital gains tax rate, there's only 3 rates. Well, for the most part. I mean, you want to learn more about additional tax rates, go watch our video on capital gains rates, and you'll actually learn about all the tax rates that you can have under capital gains. But generally, there's three major categories. You have 0, 15, and 20%. And that's determined based on your bracket that you fall into. And that's why I set it up this way. So we talk about marginal rates first, and then we talk about capital gains rates later. So if you take a look at your brackets, if you fall into the 10 or 12% tax bracket, your capital gains tax rate is going to be $0. Okay. Now, if you fall into the maximum tax rate of 37%, your tax rate is going to be 20%. If you fall into the other tax brackets, you got a 15% tax rate on capital gains taxes. Now, when I'm talking about the tax rate on capital gains, I'm not mentioning or adding in addition to that the net investment income tax. That's actually another video that we're going to do later on where we're going to talk about net investment income tax and how it affects individuals. But that could potentially add another 3.8% on top of the capital gains rate that you pay. But we'll get into that in another video. Well, folks, that's all I got for today. My name is Kevin Matthews. I am the tax professor. Remember, class is going to still remain in session because the learning never stops. Feel free to go watch any of our other videos. And if you've gotten to this page, you probably will find the playlist in order for our videos. And also something else, folks, if you really enjoyed this video, I would invite you to like it. And if you really like this video series, especially, go ahead and subscribe. And then as we start kicking more and more of these videos out, you'll get notified of it. I mean, I have right here the notes to make probably about another 20-25 additional videos. So you want to be the recipient of some of that when it comes out. Again, and if it's a topic you don't enjoy, don't worry about it. You can watch the next one next week. It's not a big deal. There's going to be a wide variety of topics that we're going to do. So again, I want to say thank you very much for the video. If you want to reach out to me, you can leave a comment in the comment box below, or you can go to my website at www.betasolutionscpa.com. Again, that's www.betasolutionscpa.com. And there's an email address that you can reach out to me for on the link that basically is it's an info email box. Again, we want to say thank you very much for watching the video, and have a good day.